The Chinese economic landscape is turbulent, and recent data underscores just how critical the situation has become. In August, both factory output and retail sales in China fell short of anticipations, reigniting discussions about the need for more stimulus in an effort to bolster growth in the world's second-largest economy, which is currently grappling with sluggish consumer spending and external challenges. According to figures released by the National Bureau of Statistics, industrial production rose by only 5.2% compared to the same month last year. This figure represents a decline from July's growth of 5.7%, and it also falls below the projected 5.7% increase anticipated in a Reuters poll, an indicator that the economy is not bouncing back as hoped. Meanwhile, retail sales, which serve as a barometer for consumer spending, with the aim of meeting Beijing's growth target of around 5% for the year, officials are counting on manufacturers to explore new markets. This necessity arises partly due to unpredictable trade policies under U.S. President Donald Trump and a lack of robust domestic demand. The troubles facing the Chinese economy have deepened since the momentum that had built up during the COVID-19 pandemic began to dissipate. Concurrently, governmental measures aimed at reducing speculation and curtailing excessive borrowing have resulted in a protracted slump in the real estate sector, further contributing to economic stagnation. Recent data also indicates a 0.3% month-over-month decline in new home prices for August, with an annual drop of 2.5%. This ongoing decline in the property market has been a continuous burden on broader economic growth. Chinese families have begun to tighten their budgets, particularly in light of diminished wealth caused by the difficulties in the real estate market. This, combined with a drop in business confidence, has negatively impacted the job market. In terms of exports, an essential pillar supporting China's manufacturing economy, the growth rate recorded in August was the slowest it has been in 6 months, with both American and Chinese producers keenly observing how their respective governments navigate the precarious path following a temporary ceasefire in tariff conflicts. This slowdown raises concerns about future trade dynamics. Furthermore, profits for factory owners in China have been pressured by prolonged declines in producer prices. Manufacturing activity has also been affected by extreme weather events experienced this summer, which marked the hottest conditions not seen since 1961, alongside the longest rainy spell in the same time frame. Fixed asset investment, a crucial measure for economic activity, experienced a growth of only 0.5% in the first 8 months of the year, a stark contrast to the expected rise of 1.4%, and down from a growth of 1.6% from January to July. Zhang Shangye, who oversees China's state planning agency, made statements last week affirming that the government plans to fully utilize fiscal and monetary tools at their disposal to achieve the annual economic objectives. He also emphasized the necessity of performing ongoing policy analysis and expediting the application of new financial mechanisms in the latter half of the year. What do you think about China's economic strategy? Will the new policies be enough to turn the tide in a challenging global landscape? Or are they merely a band-aid on a deeper issue? We'd love to hear your thoughts. Do you agree or disagree with this outlook?